This is why the rich pay less tax than you. These are 4 legal they don't teach you at school. You ever wonder why your tax return only gets $500 back, while those retired boomers, those old mates get $30,000 from that? That's not luck, guys. That's structure, baby. And they've been playing chess while you've been doing TurboTax Sudoku. Today, guys, in that property roast, I'm showing you the actual tax playbook used by wealthy Australians that no one school, no TikTok guru, and no accountant on a 20-minute Zoom call will ever teach you. We're going to go on a deep dive on how the 4 asset structures, trusts, companies, super, and personal will totally change your tax outcome. We'll also look at when paying tax is actually smart and when it's a trap. And we'll also look at how debt recycling and franking credit refunds make the tax office your ATM. And why, guys, in the month of June is too damn late to start planning your taxes. Because serious wealth tax planning is actually built on January, the early part of the year. So hopefully, guys, you got your scuba gear on, because let's dive in. Firstly, guys, the 4 tax structures that decide your tax fate. Because let's be real, guys, in Australia, your asset doesn't matter as much as where you park it. And here's the tax breakdown by structure. To give you a very simple example, you sell a $500,000 asset for $800,000. Say you do it after 2 years. The capital gain is $300,000 because when you do the maths, you have $800,000 minus $500,000 equals $300,000 net profit. Now, if held personally, the $300,000 will be taxed at 50% on the capital gains tax. That's if you held the asset for more than 12 months. And also, we're not talking about any owner-occupied purposes. We're talking about investment purposes. Say, for example, this was an investment property, or say, for example, these were shares, which means you get $300,000 divided by 2, you get $150,000, and that $150,000 is taxed at your marginal tax rate. So, for example, if you're already earning $180,000, you're already taxed at 45%. And if you don't have any like private insurance, there's a 2% Medicare levy surcharge. So you'll be taxed at 47%. For example, you're earning $180,000, then you add another $150,000 on top of the $180,000. And if my math is correct, that's $330,000. That will be taxed at the highest tax bracket of 47%. Haha, sucked in. Now, if you held this structure in a company, the full $300,000 is only taxed at 30%, which means if you do your maths, it's only $90,000. Now, mind you, capital gains tax is zero exemption for a company purpose vehicle. So unlike the personal example where you're taxed at $150,000, you will be taxed at $300,000 under a company, but at 30%. And guys, if you held it in an SMSF entity and say you've reached pension phase, it's zero tax. For example, that $300,000 of net profit, zero tax. FUA. To quote Peter from Biola Wealth, he says, quote, "The superstructure is far and away the best, but the hard part is getting the money into that bucket," end quote. So guys, here's my take. You're not overpaying tax because you're dumb. You're overpaying tax because you're parking your assets in the wrong garage. Secondly, guys, right asset, right bucket. Here's the matchup table. I'm going to throw this table up at the moment. Let's assign the right assets to right buckets. And pay attention, guys. Because if you make the mistake by putting a capital growth asset in a company structure, even though you think, oh, companies are great, I'm telling you, by doing that willy-nilly, it's like putting a Ferrari on a goat track. You'll kill the benefits. So right now, guys, if you look at the table over here that I've put up on the screen, you'll see that under personal, it's 50% discount if held more than 12 months, right? So the example, again, is what I've given before. But what I want you to see is, for example, company, no CGD discount. However, it is taxed at 30%. Now, it could be 25% depending on how your account is set up, but it's usually 30% on average. And it says here, flat 30% tax looks neat, but you lose the 50% discount. So that's why this table is really good. Take a snapshot of it because it allows you to think, hey, before I buy a property, before I buy shares, before I set anything up, what are the 4 types of structures I need to get myself into? A lot of people think, oh, you know what? I'm going to buy something, shares, property, whatever. I'm just going to buy under my personal name. They don't think about, I actually have 4 choices, right? I can buy under a trust. For example, under a trust, discretionary trust or family trust, 50% discount passes, same as the personal, right? And you can pass that through your beneficiaries, right? For example, you have parents that do not work. For example, you have kids that are around 18, 19, right? They're not like 2 or 3, right? That's not good for a trust setup. trust is not good for everyone, by the way. It's when you're in your like sort of 40s, mid 40s. For example, I'm in my early 40s. You know, I distribute it to my parents, right? My kids are pretty young at the moment, but when they hit 18, I can distribute that stuff to them, right? And the next thing that I have, and many of my clients have, is an SMS structure, right? Use your SMSF to go buy a property, to buy whatever shares or assets, commercial properties, right? When you retire, when you declare to the, or to the police in Canberra that you're retired, you know, that sale of the property, say you generate $1 million, is exempt from CGT, zero tax, right? That is the holy grail, right? I'll put it here. It is the holy grail, but only once you're in your pension phase, right? So this is like a set and forget strategy. Anyway, guys, let's move on. To quote the Australian Bureau of Statistics, 38% of Australian rental investors have claimed negative gearing, but over 60% of them miss tax optimization due to poor structure. So guys, this is my opinion. The wealthy don't just invest smart. They invest in the right name, the right structure. And let me tell you what, it's usually not in their personal name. Now, thirdly, guys, I'm going to talk about when paying tax is actually smart. Because here's the savage truth that no property broker will ever admit. Sometimes triggering tax is actually a smart move. Let's just say, for example, you hold a $500,000 position in ETFs. And let's say you bought that under your personal name. And right now, you want to restructure that into a trust or SMSF, a self-managed super fund. And say, for example, you're doing this for the long game. You could, again, not financial advice, you could crystallize a $100,000 gain right now, like sell it, pocket the $100,000 gain, go and pay the $23,000 in CGT. That's roughly what the CGT will be like. Like, for example, you're on a 47% marginal tax rate, and this is after a 50% discount. And then from the net asset, for example, it was $500,000, then you minus $23K in expenses, you will net $477,000. You can reinvest this remaining $477,000 inside a structure that permanently cuts your tax moving forward. And right now you might be scratching your head thinking, hey Q, that's a 23K loss. But when you think about it in a long term, for example, you put it in a trust structure, a discretionary trust, or an SMSF structure, it's actually just an entry fee into a lifetime of smarter tax. Now, to quote a spokesperson, they've said, quote, even if you've got unrealized gains, moving into a flexible structure early can really put you in a better position long term, end quote. Because according to Australian Bureau of Statistics and they've said that over 200,000 taxpayers triggered CGT events voluntary to reset their structure. And I'm telling you right now, most of the $200,000 in this 23 or 28 million population of Australians at the moment, those 200,000 taxpayers are really the 1%ers, the smart, wealthy folks that have caught on to the game of legal tax evasion, where they're moving all their assets away from their personal names and into these tax efficient structures. So guys, this is my take. Not financial advice, but tax isn't the enemy, guys. It's actually just a toll. And like many of my clients, they just pay it once just to get onto the highway of financial freedom. Now in this fourth part of the video, I'm going to talk about debt recycling. This is the rich man's weapon of choice. But also on the negative side, it's also his undoing. So guys, this is how the game works. For example, you got a $1 million home. And for example, you got a $600,000 mortgage. And then through debt recycling, you take out the $200,000. For example, you have to split it in a very tax efficient manner. And I'll show you an example later. For example, you take the $200,000. This is just a bird's eye view at the moment. You then invest the $200,000 into an income generating share. For example, when you receive the dividend, what happens is you get the profit and you dip it back into your non-tax deductible home loan. And slowly by slowly, you convert your bad debt, which is your non-tax deductible debt, into investment debt. Now, for most of you right now, you must be scratching your head thinking, Q, what the heck are you talking about? Let me show you a diagram. So right now, I'm going to pull up on the screen how this looks like. So we have this diagram over here on debt recycling with shares, right? Now, when I say redraw, I don't mean like you use the money from your redraw. What I mean is like you split the loan up, like I said in my equity release video, if you saw that before, right? And then you pull it out. That loan is repurposed for investment purposes. Don't get the word redraw wrong, right? This is just a quick explanation in a diagrammatic form. So basically, again, $1 million value, 600K mortgage. What happens is we will split the loan of 1 mil over here. Okay, so over here, so what happens is then we have loan number 1, which is 600K. Then you have loan number 2, 200K, fully offset with the 200K loan. This is what I'm talking about. right? That's what I mean by redraw, like you draw back into it. But wrong word, just say debt recycle, right? My bad. So what happens is then you use that to invest in a 200k shares or something that has a return on investment, right? It could be shares, it could be property, it could be whatever, right? So you get a return on investment on that, right? And then you get obviously cash flow dividends, right? Depending on how much those ETFs are paying. For example, they are paying, I don't know, 10 to 20k a year, right? So what happens, you use that money to pay down the 600k loan, right? Which is the non-tax deductible debt, right? That reduces the non-tax deductible debt. You then go down to use that money to pay down the owner-occupied debt, right? Say you pay it down, and say you have about maybe another 200k redraw after maybe 2 or 3 years, and then you rinse and recycle this process, right? You rinse and recycle this process again until your non-deductible debt goes down to under $50,000.
Reduce,
right? Ideally, right? Say your owner-occupied debt, 90% of it is now tax deductible, and it's legally tax deductible, right? Don't do the stupid stuff where you just take it from your redraw and then you take it back out, right? And then you do this whole process and wash it. It's a really dumb process because you're colluding your debt. Your debt, it's called debt contamination, right? You got to really split the goddamn loans out like black and white, right? This 200Ds, like for example, you're like, hey, that's for investment purposes. This one is actually owner-occupied. Rinse and recycle it more where you're going to move more of this debt into the second loan split. Hopefully that makes sense. Anyway, let's go to another point. Let's talk about the trap, the negative side of debt recycling. Not a lot of people talk about that, right? I talk about debt recycling like, oh, it's fantastic. But as a very experienced broker and a no BS broker, I like to give you the flip side, right? For example, if the market crashes and you can no longer service the debt anymore, you're basically stuck with this structure, right? You're basically stuck with this structure. If your income drops and you're overextending yourself because you've been like drawing money out and buying all these shares and all that stuff, right? And say, for example, the market crashes, right? And you're forced to sell assets at a loss. And say in this process where you're recycling debt, right? You're moving from unoccupied debt to investment debt, which means you carry a higher interest rate on the investment debt because the unoccupied debt's always lower. You're basically, refinancing it at a 6.5% interest rate just to chase, for example, a 3 to 4% dividend. Man, that is whacked. If that's your strategy in terms of debt recycling, that is the wrong way to use debt recycling. You really, really need to have an experienced financial advisor, an independent one, and an independent accountant, along with an independent broker, wink, wink, like myself, to really check in this strategy before you do debt recycling. So guys, this is my honest opinion, right? Debt recycling is like steroids. It only works great if you don't screw up the cycle. But if you noobs out there don't understand the rules, it's just basically financial roid rage. You know what I'm talking about? Roid rage, right? You're gonna get cooked, guys. Now let's move on to the fifth part of the video. We're gonna talk about franking credit farming. This is legitimately the legal ATM for boomers. So guys, let me explain this through a diagram over here, right? So right now, we got a company that pays 30% tax, right? On average, a company pays 30% tax if you set up a company, right? And say this company went and bought some shares. For example, a $500,000 to a $600,000 share portfolio, right? It gets distributed a dividend of $70,000, right? But on top of that, guys, it's $70,000 paid dividend with a $30,000 franking credit. So what happens is you get a $70,000 dividend paid with attached franking credit, right? Now, right, if you're looking at this process, I'm going to go to another screen to explain this whole process, right? And again, this is not financial advice, guys. So you have a company, and then you use the company to buy Australian shares, for example, right? These companies receive fully franked dividends, right? Just like any individual would, right? But here's the trap, guys. Companies don't get the 50% CGT discount on capital gains, right? So if they hold the shares, the franking credits stick inside the company unless distributed, okay? So what happens, step 2 is you can choose from your company who your shareholder is, right? And in this case, rather than choosing yourself as the director, you can choose to distribute it either through a trust or a SMSF, okay? Now, if you set up an SMSF, for example, I have a lot of clients that are using their SMSF to buy property, you can recycle this SMSF and use it to receive dividends from these blue chip shares that have fully franked dividends. Okay, so what happens is now, if you go back to this diagram, if you're in pension phase and you're receiving this dividend as you're in pension phase, for example, you're 65, whatever it is, the will refund $30,000 back to you. Right? That's the secret wealth strategy here, guys. This is how the boomers are getting money every single week just by doing this tactic, right? So what happens is, if you're retired in your SMSF pension phase, there is zero tax, right? You get back the 30%. So for example here, the $70,000 that's fully franked, you get the $30,000 franking credit. So you get 100 cheese. So in this case, the net result is you have 70K dividend plus 30K refund. You have a $100,000 income from this share portfolio. And by the time you retire, depending on how you manage your portfolio, for example, you're diversified not just in property but in shares, that can be your passive income per year. Imagine having $300,000 of passive income from your share portfolio alone. Combine that with, if you have a multiple of investment properties throughout the years that you purchased, for example, 10 or 15 years ago, if you bloody listen to me and start doing something right now, right? You could have maybe $500,000 of passive income from the rental income, and you already paid down the loan because you aggressively paid out the loan through the last 15 years. Plus this strategy over here, and then you'll be banking on an incredible lifestyle in your retirement years. Now, a lot of you might be thinking, hey, this is too good to be true, Q. What if like they get rid of it, right? Well, according to an article in 2019 by the Australian Financial Review, they said, quote, lost the proposed franking credit refund cuts. And that's because the boomers against them, end quote. And to quote Boola Wealth in 2024, they said, quote, franking credit recycling in super is one of the most powerful wealth preservation tools we've ever seen, end quote. So guys, this is my take, right? Not to just give you guys financial advice. I just want to give you a taste of what our clients are getting from our independent financial advisors and independent accountants. If you have the brain cells to listen further, right? My take, guys, is the boomers, like we hate them, but then I love them, right? I have a lot of clients that are boomers, right? But the boomers have figured out how to make the tax system spit money back at them, and legally. Like millennials and Gen Zs who are like scrolling on TikTok and all that stuff, right? Like you guys are still fumbling around trying to deduct your work laptop or your work mobile, right? And right now we're moving on to the final part of the video. Why tax planning starts in January of the financial year, and why you shouldn't wait until the end of financial year to start your tax planning. Because guys, let me be blunt. If you're just doing your tax returns now, just in response to, oh, well, 30th of June was the end of financial year, and this is the 1st of August, and right now it's like September, this is when I'll start doing my tax returns. I'm telling you right now, you're too late, right? Most of my savvy investors, they already start thinking about their tax and their tax structure in January 2025. So right now, if you're watching this video, I want you to put your brain cells on and start in January 2026. It's not too late, but don't repeat the vicious cycle of being too late, because you're already lost if you're starting too late. The rich, the people that I deal with, they don't wait for the end of the financial year. They start planning in January or even in December, like this Christmas. And you might be asking and scratching your head and go, hey Q, why? Because I'm telling you right now, most powerful tax moves are based on financial year caps. So if you haven't used them by June 30th, they vanish. Let me give you an example. Let's take concessional super contributions. Like right now, we're in September 2025 as I'm recording this video. This means this tax year will end on the 30th of June 2026. So the concessional super cap rate at the moment is $30,000 per person. And this was updated from $27,500. Now, right now, you can carry forward your unused caps from the past 5 years if your total super is under $500,000. So for example, right now you're sitting down with your independent broker or your independent accountant or your independent financial advisor in January 2026, which is a few months away. You can actually have a bit of time to review your taxable income to date and really estimate how much profit you've made. Say for example, you're earning $160,000 and you know before the end of financial year 2026, you're going to receive, like for example, a 30K bonus. That's going to tip you over $180,000 of personal income, which means you'll creep into the 45% tax bracket. You can, if you are smart about your tax planning, do a $30,000 concessional super contribution before June 30th, 2026. And then this contribution is only taxed at 15%. Versus if you left it too late and you didn't do that, that extra bonus that you receive, and you didn't do the concessional super contribution, you would have been taxed at 39 to 47%. But again, guys, not financial advice. But to quote Peter from Boola Wealth again, he says, quote, people say super is for old people. But no, super is the only structure where you can legally pay 15% on a 6-figure income and no one blinks, end quote. And according to Australian super contributions in 2024, they've said that nearly 1 in 4 Aussies miss out on deductible concessional contributions due to bad timing. So my take, guys, is if you're those late end of financial year tax returners, for example, you wait until the end of the financial year just to do your tax returns and then you realize everything's too late, start planning more smart for your tax. I want you to pull out your calendar. For example, you might have Google Calendar on your phone, whatever. Put it in January, put a reminder. It's time to review my tax strategy. January 2026, not 30th of June 2026. So if you've watched thus far, kudos to you. You guys are either fans or you're really concerned about your tax structure and you really want to learn more about it. I want to say to you guys, you don't have to be rich to play this game, guys. But you do have to do one thing. Stop being bloody lazy. Tax is not about dodging the rules. It's about knowing the rules better than the average accountant. So for you guys who are watching out there, if you want to build wealth, pay less tax, and finally stop wondering what a bucket company actually is, I want you to book a 15-minute strategy call or a 60-minute deep dive. And if you want an upgraded platinum call with me and my team, we have an upgraded platinum strategy call for you to book where you speak to all my network of A team who are also savvy property investors. Go to my link and then book the Platinum Portfolio Accelerator right now. But hey, if you're not ready, just hit the like button, hit the follow button if you like more videos like this, and most importantly, smash the share button because knowledge is power, and I want you guys to share this power to your mates, your family, and your colleagues, because at the end of the day, we all know that we're living in a rigged system, so you either let it rig you or you rig it back by playing smart. And until next time, I'll see you in the next couple of days in that Property Roast.